That lady just said her mortgage went from $3,400 to $5,300 a month. Yeah, go and wrap this up. Go and wrap this right on up. I just earned myself a ticket on the next flight out over there to that farm with Wheelbarrow and Charlotte's Web. They better move on over.
Home ownership in America is in serious trouble. What we're facing isn't just a challenge, it's a full-blown affordability crisis.
Going to lose their homes. They're going to lose their homes. I'm telling you guys, the storm is brewing and it's coming fast. The rate of acceleration on property taxes and insurance is unlike anything anybody has ever seen. People's monthly payments are going up from $1,800 to $2,800, from $2,500 to $3,500. One of two things can happen. You either lose your home to foreclosure because you can't afford that payment, or you try to sell your home so that you can get out of this terrible situation. And the more people that start to now try to sell their homes, the more inventory increases, the more those prices are likely to come down. This does vary state to state, so it's not exactly the same in every state. Some states are in worse situations than others. They weren't kidding. Those f***ers weren't kidding. They said you'll own nothing and you'll be happy.
Now, if you're upset about how high your mortgage payment has gone up, as you can see, you aren't alone. But today, I've got good news. There's finally some relief coming your way due to the big, beautiful bill that was just signed on July 4th, 2025.
Tell me what it is.
It's a little tax law called the SALT deduction cap. Now, you're probably like, what the heck is SALT? Don't worry, I'll explain it all and give you a breakdown. But first, if you don't know me, I'm Marcus Mays, a licensed realtor here in Texas, here to help you buy, sell, or invest in real estate. Whether you're making your first move or your next big one, I'm your go-to. You got questions, go ahead and drop a comment or schedule a call. I'd love to chat and see how I could be of service. Schedule a call with the link in the description. Also, if you want to stay ahead of the Texas real estate market, go ahead and sign up for my free weekly newsletter. It's packed with updates, insights, and smart tips to keep you in the know. Also, the link is in the description. So here's the deal. If you've noticed your mortgage payment creeping up and you're wondering, wait, something's up.
Something's not right.
Let me tell you exactly what's going on. Your property taxes are increasing, your homeowner's insurance premiums are rising, and your escrow account is just wondering,
What the heck is going on?
I've had multiple clients here in Texas tell me their monthly mortgage payment has increased anywhere from $300 all the way up to $1,000 a month. And not because of their loan, it's because of the local tax assessments and insurance premiums are climbing faster year after year.
My mortgage payment went up nearly $1,000 because my property taxes more than tripled from last year to this year. So let's talk about it. I bought a house last year, May of 2024 in South Florida. I purchased it with FHA at a 6.625 interest rate at a 30-year fixed. Now, my mortgage payment alone, just with principal and interest, was $2,277.05. It's important to note that that's not what I'm going to pay the lender every month, because you have to add on top of that your property taxes, insurance, and that's held in escrow. Escrow is a separate account managed by your mortgage lender, which holds the funds for when it's time for you to pay your property taxes and home insurance. Some loans require that you have escrow, and in this case, because I have FHA, it's mandatory to have escrow. I have to add up my insurance, my property taxes, as well as mortgage insurance.
So, why does this matter? Your escrow is where your lender holds the money for your taxes and insurance. If those go up and your escrow runs short, guess who pays the difference?
Honestly, I have no clue.
You do. And usually it causes a sudden hike in your monthly mortgage bill. Here's an interesting fact. The Urban Institute reported that nationwide property tax collections increased by 12.2% between 2020 and 2023. And some high tax states like New York and New Jersey saw even greater hike. And when you really look at it, this affects homeowners big time, especially middle class buyers in high tax zip codes. It's getting harder and harder to predict housing costs, and that uncertainty puts strain on people just trying to stay afloat.
Nearly impossible.
And unfortunately, this has negatively impacted homeowners over the past few years. From 2021 all the way to 2024, mortgage delinquencies in high tax states rose by 18%, according to the Mortgage Bankers Association. And in certain counties, especially here in Texas, California, Illinois, and New York, tax lien sales are up as much as 35%. That means when people can't pay their property tax, the government is selling those debts to third parties. Yep, our favorite, debt collectors.
Yay.
And that's not something to take lightly. That's not just something like a late fee or anything like that. That's putting your home ownership at risk. So the question is, what can you do if you're in this boat? Here are a few solutions to keep in your back pocket.
Well, keep that in your back pocket.
Appeal your property tax assessment. Yes, you can appeal it. If the county has overvalued your home, you can challenge it. Many homeowners don't know that this is an option. You can also budget smarter. Property taxes often rise yearly. Go ahead and plan ahead and over budget by about 5 to 10% so that you can over budget your escrow savings. You could also shop your insurance. A new policy might drop your premiums significantly, especially if your current provider hiked your rates due to flooding, storms, or wildfires. Also, if interest rates allow, you can refinance if possible. Even a small rate reduction could free up monthly cash to cover increased taxes. The point is, don't wait until you're 3 months behind panicking. Be proactive.
You can never be too prepared.
Okay, let's discuss the good news. The SALT deduction cap just went from $10,000 to $40,000. Yes, you heard that right. 4 times higher.
Impressive.
Let's do some quick education to break down exactly what this is. So, SALT. SALT stands for state and local taxes. It includes things like your property taxes, state income taxes, and possibly some other sales or local taxes as well. So, what has changed? Since the 2017 Tax Cut and Jobs Act, the SALT deduction was capped at $10,000. For homeowners in states like California, New York, and Illinois, this cap meant they were paying way more in federal income taxes because they couldn't deduct their full state income tax, or like in Texas, our local property tax payments.
I hate taxes.
Now the cap is $40,000, and this opens up huge savings. So here's an example. Let's say you pay $18,000 in property taxes and $12,000 in state income taxes. That's a grand total of $30,000. So before you can only deduct $10,000. Now you can deduct the whole $30,000. And if you're in the 24% tax bracket, that's over $4,800 in tax savings per year.
How does the big beautiful bill benefit tenants, homeowners, and/or real estate investors? Let's talk about it. SALT stands for state and local tax. This is a deduction you can take for all of the state and local taxes you pay. So for those of you that know, you can deduct the tax on almost anything you pay. Grocery stores, shopping, cars, all of that. But the thing is, you have to itemize your deductions. You cannot take the standard deduction. And this might be better explained using like real numbers. So let me give you real people. Say you have a tenant, a homeowner, and a real estate investor who all make $75,000 per year. Each person can technically write off all of the taxes they pay. However, you have to be itemizing your deductions. The standard deduction for individuals is $15,700. So unless you're deducting more than that, odds are you're going to take the standard and this will be your adjusted gross income. If you own property, there's a big chance you are paying more than $15,000 in taxes. Especially if you're a homeowner who lives in a state with really high property taxes, or you're a real estate investor who owns a lot of properties. So the sum of all of the taxes you pay is more than $15,000. Before the big beautiful bill, the SALT tax cap was $10,000. So homeowners and real estate investors could itemize at least $10,000 in property taxes. And then for real estate investors, they can itemize more business expenses. But now the SALT cap has increased to $40,000, at least until 2030, meaning homeowners and real estate investors can write off a lot more of their homes and investments than they could prior to this bill, lowering their overall income and their tax burden. So which of our $75,000 earners does this particular change benefit? People who have higher property taxes and now might consider itemizing their deductions because the SALT cap has been increased.
Now you may be wondering, how do I use it? 1, you must itemize your deductions. The SALT deduction only helps if you skip the standard deduction and go itemized. Number 2, track and save your records. Save every local tax bill, property tax receipt, school tax, and state returns. And make sure you work with a CPA or a tax professional to ensure itemizing your deductions is right for you. Don't let a software decide for you. A tax pro can structure your deductions, but heads up, if you make over $500,000, the increased cap phases out. But even then, you may benefit depending on your deduction. So if you're already a homeowner, this new SALT deduction cap might be the extra breathing room you've been praying for, a few thousand extra bucks at tax time. Now for my buyers, if you're thinking about buying a home within the next couple of years, focus on the cost of holding it long term, including the taxes, insurance, and yes, the tax deductions like SALT. Now, if you want to explore where to buy, how to budget smart, or just plan to avoid tax surprises when it comes to owning a home, I got you. I'm not here to just help you sign paperwork. I'm here to make sure you keep your home and save money along. Go ahead and drop your questions in the comments or schedule a free consultation using the link in the description. Thanks for watching. Go ahead and smash that like button if this has helped you. And don't forget to subscribe for more advice about real estate and finances. I'm Marcus Mays, and I'll see you at the closing table. Peace.